Okay, welcome. This is, as usual, a sound test. If there is anyone, if you are hearing correctly, just type on the chat window that uh, sound is fine. Thank you, Andrew. Let's wait just a little bit for more people to join before starting. Thank you, Eric. Hello, Patrick. No problem. Hopefully, you guys will enjoy it. Okay, so 1 p.m. we have enough people, and as usual with YouTube is on demand. So even if someone joins late, they'll be able to see it from the very beginning. So let's start right away. So this is the second live session of the Gamma Optimizer room for 2020, and we are going to do one every week, every Friday. So we'll see what we have for today. So let's talk about a little bit about the positions. Is basically, even though it's January 10th, is basically the first full week of the year. No, so we have finally a whole 5 sessions to enjoy for the year, and the results are in, and it has been really good so far. Remember, just before going on vacation, just before on the December 31st to be exactly, we opened a first trade for 2020, and it was bullish trades, no? And they have performed fantastically. The official trade, I was we entered at 195, but I exit early just because I really wanted to give it more one more week last week. So I have an official close at 205, but I know most of you kept the trade on until this Wednesday, and you managed to get 4.4 on it, and it was good. But I'm just taking the official, so only a 5% return on that one. And then we have the Ultra 4 trade that we closed this morning. We have been closing it in 2 steps. We closed it um, yesterday or the day before yesterday a little bit, and today another bit. So we entered at $1.9 that trade, and we exit at 325 and 45. So we have an average of 363 because I exit a big chunk. So it was more like 70%, 30% kind of exit. I exited a big chunk and I kept a little bit for today. But anyway, a return of 91% is not bad at all for a trade. And I'm very happy. I'm very happy with the first trades. These trades were based, um, inspired by the neural nets that we use. And they were looking for at least 1% upside or 3% downside. No? So it has been good. And so far, the start to 2020 has been excellent. The return on the account is been 9.1 for the first week. I like it so far. I like we are starting the year with with the right foot, and this opens the door to the real main point of discussion for the presentation today. That it seems that the performance of the room of my trades is really good, but the performance of your own trades doesn't seem that good. And it should not be like that. I mean, everyone should have a fantastic performance. I don't think there is a big difference between the way I trade and the way you guys trade. The only difference I have noticed is trade management, and I really want to focus on that on this particular presentation because I really want all of you to have a great year like the one I had last year. No, you remember last year we did more than 100%, or I did personally more than 100% officially, but I know some members struggled to finish the year on green, and that was due to terrible trade management. So let's cover, let's go into that. No, what is the whole point of trade management? I guess the only reason that I guess you joined the Gamma Optimizer room is just to learn about options and see how we can use options to use our returns, but also to make money and to be profitable. No, I guess that's why everyone joins. And it could be hard to see everyone else making money and you are not making that much money as those persons, or you are losing money. And at the end it boils down to just psychology. We humans are really interesting. We don't manage well our risk, and that's kind of at the heart of underperformance. So let's review quickly how I manage my own risk, and hopefully I can inspire you to do something, to improve your own risk management. So to me, every trade that I take in the GammaOptimizer room, I visualize it as risking all capital. That's it. I don't visualize and stop at the inception of the trade. So if the trade cost 190, we are risking 190. That's what I'm willing to risk. So if 190 is all my capital, I know I'm going to get bankrupt if this thing doesn't work. So that's the first thing you as a trader have to figure out. If the cost of the trade is all at risk, never risk all your capital in it. No, size the position based on that fundamental truth. The fundamental truth is that you're risking it all. So if you're risking it all in the trade, risk a fraction of your working capital so you can redeploy more later on. So that's the first rule. No, just always visualize that. Don't think that a stop will save you later on. Don't think that luck will save you. Just size your position, thinking that you're risking it all. Okay, so as an example, I have the Ultra for trade we closed today. The initial cost was 190, no, 1.9 per contract, so $190 for one contract, and that's it. If that was a painful risk for you, you should have not followed this trade. No, $190 was a lot of risk, and but if you had $2,000 in your account, 190, it is substantial. It's almost 10% of your account, but it is doable. I mean, it's not that much risk. Risking 10% on the trade is, in fact, is the recommended risk. So even though I use Kelly criterion to size all my trades, I try to simplify it a bit for you, for the members of the GammaOptimizer room, and I recommend for this kind of trades in particular, just go one contract for every $2,000 you are allocating to this particular strategy. You might be running several strategies. You might be doing gold, you might be doing, I don't know, volatility, you might be doing miners. But if you're doing options and you set aside $2,000 for the options trades, then you do only one little contract. You will think, man, that's nothing. But I'm telling you, this will keep you alive for the whole year, and it will return really good money. And of course, if you have $20,000 allocated to this, then you can use 10 contracts and so forth and so on. And something that people forget, I don't know, I noticed that some members forget about this. Remember that the way we trade in the GammaOptimizer room, we tend to use binary options replications. So that means that our profits are not unlimited. We have constrained profits, and the maximum value of a position is $5. That's the maximum you will get out of it. No, so and I mentioned this because it seems that people seem to wait for more and more. I mean, if we're really close to $5 already, why do you want to wait for the five? If we are at for like 470 or 480. Why would you wait 10 more cents before closing the position? It makes no sense to me. Remember, this is a binary strategy. We can make a lot of money or we can lose it all. So I'm going to review this. So keep in mind these principles, that you're risking it all, that it should be a fraction of your account, and that the maximum winning on these positions will be always $5 based on the cost. So with that is the best way to size your trade. And just a quick parenthesis. Remember, folks, you can ask questions at any time. No, just type on the chat window of Google, and I'll see it and I'll answer it as I'm presenting. Don't wait for me until the very end. So with that, so we started our trade. Now, in the case of the Ultra trade, we risk the $190. I say, okay, yeah, let's go in. I have $190 to spare, and suddenly, remember, these trades are based on really hard targets. The target is hit. We see that the target is, the trade work, and it worked a little early than we expected. No, so what do we do? What do we do in that situation? So my recommendation is to do two things, one or the other or both. You could take partial profits. I see if you we are seeing the target already and the prediction was correct and we are actually seeing nice green. I don't see a reason why not to take the money off the table. I know a lot of traders recommend, oh, let the winners run or whatever. I don't know. I am not that kind of trader. I am a trader that if I have a decent profit on my trade, I'll take profits. I let run a little bit more, but the idea is that I want to take risk off the table because as the position becomes more valuable, then we are risking more. So for instance, and we saw this last week with the first trade of the year. We saw that the trade was at 4.5 on Wednesday. Now 4.5 out of 5. No, so people were sitting on a very, very nice gain, more than 100% gain on a trade with a less than 1 week, and yet they refused to close because they wanted to get that 5. I don't understand. Why will you risk all of your profits for only 0.5? And perhaps it's because you come from the world of stocks or a different world where people just let the winners run because in theory profits are unlimited. Now the stock could go to infinite and beyond, and the longer you held into it, the more money you make. But here, in these trades we are doing, that's not the case. In the trades we are doing, there is a maximum gain, and you are really close to the maximum gain, so there is no point on risking it. And the question is, why will you risk $4.5 to make 50 cents? No, just keep, put that question in your head, later resonate with you. And that will bring you to the last point here, that risk reward is the most important parameter of a trade and of any trade. You have to be cognizant, you have to be aware of what is the risk reward for the particular trade you're doing. So in this case, if the trade costs 1.9 and the max value is 5, the net gain is only $3.1. No, that's what you're going to make in net profits. So that gives you a risk reward ratio between what we profit and what we risk of 1.63. And I think that's decent. To me, my personal rule is any trades with risk reward higher than 1.0 are trades that I want to take. I love when my potential profit is higher than the potential risk. I don't tend to be a trader that want to risk more money than I want to make. I'm not saying that I never do it. No, I take some trades when risk reward is less than 1.0, but only in a very few cases. And I mentioned this only if edge is so tremendous, is so gigantic that it is worth having a risk reward less than 1.0. But in general, for normal traders, for normal option traders, I will suggest always taking trades with risk reward bigger than 1.0. Okay, so the position evolves, so the trade evolves. We entered the trade last week at 1.9, and for instance, and this is a real life example, this morning, the trade was higher than 4.5. So in that case, you can compute the new risk reward. So I am sitting on 4.5 profits, like that's the money that I have in my hands. I am risking all those 4.5, like completely risking it, because in this kind of trade, if the trade doesn't work, the profit evaporates. It goes to zero. So the risk reward of that new trade, the trade that I'm carrying since last week, is now only 0.1, because I stand to make 50 cents, but I stand to lose 4.5. And that's when my whole brain just says, take the money and run, and do it, folks. Take the money and run. No, never risk your nice fat profits for a few more cents. There is no point. And it happened last Wednesday. The market, the position was set to give mass gain of 5. It was trading around 4.6, 4.7, and at the end of the day, it was 0. And anyone waiting for those extra 40 cents or whatever was out of all of his money. And then, that's what I'm telling you. Take the money and run. Recompute risk reward all the time. At different points on the trade, compute risk reward. In your mind, it's easy to compute this. What is the maximum profit I'm going to get? What I am risking is still higher than 1. Should I keep holding this? Should I pocket money? And that's how you should manage your trade. And so far, this is not even hard. This is not even advanced or sophisticated. We are using risk reward used to preserve our profits, used to manage our trade, and it works. And you can tell folks that it works with me. It has worked with me for more than 20 years. That's what I do. That's what I do for a living, and it gives you really good money. Okay, and the last point I want to touch is edge. Okay, so yes, we have a system that works, and it wins. Some of some of the trades win, some of the trade loses. But the best way to evaluate. Okay, we have a question. Jim, if you're always going to take profits early or at least most of the time, shouldn't you use that as a factor in sizing, Kelly? Yes, Jim, that's an interesting question, and yes, that's a factor that I use in sizing. In personally, I don't tend to take profits like full profits early. I don't tend to like close the position early all the time. What I do is I tend to take partial profits or move the stops because moving the stops is an artificial way of changing the risk reward, no. So, when I do one of those things, yes, the final profit can be lower than the max gain, and yes, and I do modify my formulas for like an exit price that is lower than 5. I don't usually use 5, but even if you use it, the change is very small in terms of what you're going to risk. Okay, so coming back to edge, remember this: the edge of any strategy is the probability of winning times what you're going to make minus the probability loss of losing times what you're going to lose. And the whole point is that the edge should always be positive. No, you should never take a trade where the edge is less than 0. No, it's a terrible trade. The only problem with edge is that how can you compute these probabilities? No, it's an interesting way. How do you know what is the probability of winning in your trade? So for a stock option, for options, or sorry, for stocks or for futures, is very hard. Who knows? I mean, you have to have a system and evaluate the system historically and see where the probability of winning is. But in the options world, and in particular when we use these neural nets, those probabilities are, let's say, are easier to compute. They are not simple, but they are easier to compute because we can really, look at historical results and see how the system is performing. So in addition to the risk reward, I like to have edge. So in my trades, I like my trades when the edge is positive and when the risk reward is higher than 1.0. And I'm telling you, if you adopt a similar system, very simple, it's not complex, you will notice that you will start having much better results in your trading. At least let's be honest here, folks. We were not going to be rich with this. I mean, options is not a way to become billionaires. If you really want to accumulate tremendous wealth, you better do, you start a company, you create things, you do, you produce something that the world wants and you sell it. But when we use financial instruments, yes, we can profit nicely, handsomely for the financial instruments, but it's not like we are going to become billionaires with them. But what we can do is we can grow our wealth with these financial instruments. And a good way of growing this wealth is to using simple rules to preserve it. So it grows, and so the risk of what we're doing is constant or is minimized. Okay, so if you have any questions about this subject, please, this is the right moment to talk because I am going to move into something completely different. I am going to move into speculative trades. I did all this. I've been talking about risk management, being responsible, and now I'm going to talk about the speculative trades. I like to talk about this because to me, a speculative trade is a very risky trade. It's a trade we do because we want to risk the money. And to me, the definition and a speculative trade is any trade that can deliver 1,000% or more return. And I know that those returns seem staggering. Like no one is used to think in terms of 1000% returns in the market. But in the world of options, it is possible. No? And I mention this because I think we are approaching the point in the market where we can start doing some speculative trades like this. And you'll see in the next slide, you'll see. But so what is the idea with the speculative trade? The idea is, okay, let's get more than 1000% return on this. Because of this, of course, that means that the odds of the trade working should be very small. No, it should be microscopic odds of um, uh, returns. Okay, Andrew has a question. Are there any books, papers you would recommend for us that expands on more complex sizing considerations? Yes, Andrew, there is plenty of literature on position sizing based on really complex parameters, like fractional Kelly, and even when you are trying when you have a portfolio with a mixture of trades with different probabilities on each. And so at the end, I'll try to post a link to some biography, to some bibliography, so you guys can check the literature on this. Okay, coming back to trades. Sorry about that. Size for a speculative trade should be really small, like really. It's like if the trade delivers 1000% return, there is no point that you use your whole capital. Just think about this. If you use 10% of your capital in a speculative trade and it works, you're going to make 100% return, which is very decent. But 10% of your capital is still too high. If you use 1% of your capital in a speculative trade, it will deliver 10% return. And that is doable. I mean, it is a great compromise. So I will say for a speculative trade, you could use up to 1% of your capital and you still get a very decent return if the trade works. 10% return is a fantastic return on the total capital, no? And the good thing about this, if you think about it, is that you could do this systematically. You could do a speculative trade with certain frequency during the year. And even if you lose every time, you're going to lose only a fraction of your portfolio, no? But if you win at least once, you are going to win a very interesting, a substantial return on this. So I do all this because I do have a potential speculative trade that I want to present to you folks. I have been looking at this trade for a little bit now. What is the speculative trade? There is reasons, I have reasons to believe that the market is going to correct pretty soon. No, I know this has been the mantra for 6 months or 7 months. Everyone is saying the same, and the market never corrects. But this is a unique opportunity right now in the market because implied volatility is so low that is allowing this kind of trade to become speculative. So for instance, I am putting this particular put spread in SPX that expires 2 weeks from now. So this trade has a time frame of 2 weeks. And if you notice the strikes, this will deliver max returns if SPX touches 300, well not touches, but ends below 3,190 in 2 weeks, which is mean more or less 2.5% correction. 2.5 down is not that much. 2.5 down is not really that much. In particular, if you notice when the market falls rather rapidly. So a 1% down day is really easy to see. A 2% down day is not that scarce once downside happens. And we have 15 days for this to happen. We have 2 weeks for this to happen. So it's incredible to me that the position is priced so low. This position, as I prepared it before the presentation, it might be cheaper or more expensive right now. I haven't looked at the market. I hope it's not crashing as I am talking right now. The position only costs 40 cents. And the max profit of this position is 460. So the return, a theoretical return, the max return is 1,150%. So right there, this position classifies as a speculative trade. So what is the point? What does it mean? Does it mean that I believe the market will fall to 0.5 in the next 2 weeks? I don't know. I don't think in the next 2 weeks it will happen. It might happen more towards the beginning of February. But the problem is, you never know. The problem is that it could happen at any point right now. So because the position is so cheap, I don't mind going a little earlier. And also because the time frame is 2 weeks, I don't mind going a little earlier. So I don't mind spending $40 for 2 weeks, and then in 2 weeks spending another $40 looking for this, because I know that at the end of this 4 week period, it must happen. It's gonna be, it's gonna profit really nicely. But right now, the pricing clearly suggests that option dealers are not thinking that this is a very likely outcome. I am telling you, this doesn't look like a very likely outcome, but there is edge and there is great risk reward in this particular trade. Now, I am going to, if you have any questions about this trade, just ask me, because I'm going to explain a little bit why I think this trade might work. No? And also remember, this is speculative, so don't go putting $20,000 on this. If your whole fortune is $20,000, don't invest on this. The whole thing on this. I would recommend at least 1% of your portfolio in this. No, I mean, that's, you want to be a little risky, 2%. So you have, spend 2% of your account in this trade, and if it works, it's going to give you 20% return, or a little bit higher than 20% return based on this amazing returns of the trade itself. So now this is the reason why I'm talking about this trade, ambiguity. For those of you that have been here for a while on the GammaOptimizer room, you know that I love ambiguity and that I follow it. And we got our interesting spike in ambiguity. The spike happened, and the spike has been similar to the spike we saw in early 2018. And if you remember, in early 2018, we saw a nice correction at the beginning of the year. Initially, I think it almost got the 10%, no? At the beginning of 2018. So I think that right now we're in a region of ambiguity where this can happen. It's a good point to start, and that's one of the reasons that I'm starting to design this trade. We have seen major reversals in the past when ambiguity is this high, and right now the good thing is that implied volatility is really low, so playing downside, playing a volatility explosion is very cheap. Okay. Also, looking at volatility itself, realized variance in SPX is only 6.7, no, for the past month. That's nothing. It means the market, even though we have seen, we have seen what? We have seen all sorts of crazy stuff in the last month. In the last month, China and the United States were not signing. Yes, we were signing. Then we have some geopolitical events outside. We have impeachment at home. We have all sorts of crazy events. And yet the market only had 6.7% variance. That's incredible. I mean, that just shows how complacent this market is. VIX is at 12.4, which is low, but it's not extremely low. It could go a little lower, but VIX is low from a historical point. Measures is low, and it could revert really quickly. And remember, volatility has been reverting, so we could see high volatility very soon. And to me, the most likely time frame for this is by the end of January. By the end of January, we are going to see VIX substantially higher values. And with this, we could play the speculative trade twice in a row and still deliver great gains. I mean, we could give it a whole month. So play like today, for instance, start a little position today, and then in 2 weeks from now, we continue, and it should hit at some point, if we are correct. And if we are not correct, if I am wrong, I am out of $80. That's what it is. So this is my favorite way of playing a top in the market, basically. So volatility, really low. In terms of the market regime, the GT level, it keeps moving up. This is at 3,153. So we are substantially higher above the GT level, like 120 points above the GT level. And the market is heavily long gamma. And remember, in a long gamma regime, option dealers have to hedge against the market. So if the market goes up, option dealers have to sell. If the market goes down, option dealers have to buy. So they provide a nice break in the market. They don't let the market go up too fast. They don't let the market fall too fast. So the option dealers right now, the long gamma regime is providing very low volatility and is favoring the upside drift that we see. The market is just drifting up, 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 up. So that's one of the reasons that I think that the volatility event is unlikely right now, because we need to at least see the SPX breaking below the GT level, and we need to see dealers switching to short gamma positions. But that's interesting because the GT level now is 3.6% down from where we are. It's incredibly low, and so the market has to move 3.6 down first, and then volatility is going to explode. So we'll see. So that's why I like the speculative trade, because the speculative trade only requires 2.5% down. We don't need volatility to explode. We just need the market to go down 2.5. So I'm opening these two questions. Oh, before opening these two general questions, just review a couple things here about the market. How is the market doing? Okay, the market is doing well. We have very low realized variance. 5.57 is expected here and for a long gamma regime. We notice that the hedging walls at the strikes we have a hedging wall at 3,250, which is massive. But then we have really small hedging walls north of 3,275. So this favors that upside is unimpeded for a while. There is almost nothing here stopping 3,300. Very, and then nothing. There is no hedging walls north of that. So that's one plus in the market. In terms of deep learning, in terms of the neural nets, of interest is that the Ultra 4 has been wrong 4 in a row, but if you look at this clearly, it hasn't been wrong at all. I mean, we have seen all of these targets. We have seen them. It's just that for some reason, just before the close, the market reverses. No, this has been outstanding. The only one that we haven't seen is the 3,290. There, I think we saw like 80 something this morning. So this is the only target that we haven't seen. But I think it's doing well, and that's the reasons the trades are doing well, because we were doing the trades based on these signals. In terms of the negative one, you notice that it's starting to generate a positive signal. So it's starting to look that the market will be below this level next week. And also, if you notice, 0.1 is starting to provide negative signals, which means that the market will be below these two levels. So I don't know, maybe finally they are conspiring again for a market fall. But I'm not getting too excited about this, because do you remember what happened last time? We only need a little tweet and the market will just move up a lot. But in terms of cycles, in terms of what the patterns that the neural nets look for, it seems that downside is starting to look more favored right now. And finally, looking at the positions, well, these are the first two trades of the year. They're doing really well. They did fantastic. I just keep tracking this for those of you that are still. Come on, guys! It's 4:55. If you could close it, just take it. Don't wait for the 5. Just take it. Don't wait for the max gain. I also tracking a Tesla bearish butterfly, but this is not an official position. I just put it here for the members that have requested this, and it's a butterfly that will deliver really nice gains by May. So it's kind of a slow cooking type of trade. But so far, this is all that I have today, and I hope that you enjoy the presentation, and I open the room to questions. If you have any questions, just let me know. I know there is a delay of like 10 seconds between your questions or 15 seconds when I see them. But if there are no questions, then thank you for attending. Thank you for joining. You can ask me questions in the main room, and you can post, I'll answer, or send me a private message. I'll answer them. Thank you very much for attending, folks. Have a great afternoon.